Don't sell yet? Why $97 silver might be just the beginning. Not because I'm here to tell you what to do, this is education, not financial advice, but because early 2026 is not behaving like 1980. Silver isn't being treated like a shiny coin anymore. It's being treated like a strategic input, and when a metal starts getting treated like infrastructure, price stops caring about your comfort zone. Right now, silver has been trading around the mid-90s after printing fresh records. Traders are staring at $97 as the psychological gatekeeper. Why? Because above that level, the market narrative flips from rally to escape velocity. You start pulling in trend followers, options flow, momentum desks, and the people who don't read fundamentals. They just chase confirmation. If $97 breaks and holds, the next conversation becomes $100, then $120. Then how far can this mania compress the gold to silver ratio? 2. This rally has a different engine. Most people still think silver moves for one reason: fear, war headline, inflation headline, central bank headline. That's the old model. In 2026, silver is being reclassified in real time from precious to strategic industrial. That matters because industrial demand doesn't take profits. It consumes metal. It destroys it inside products. It locks it away in grids, panels, connectors, and defense systems. When demand becomes consumption, supply needs to be constant, but supply is not constant. 3. The supply drought nobody can fix quickly. Here's the trap. Silver is not mainly mined as silver. Around 70% of global silver supply is byproduct, coming out of copper, zinc, lead operations. So even if silver doubles, you can't just turn on the tap and mine more silver without also mining more base metal the world may not want at that moment. That makes supply slow, sticky, and brutally inelastic, so when demand spikes, the price doesn't politely adjust. It gaps. 3. Why recycling and new mines can't flip supply overnight. People hear shortage and assume the world can just recycle or open a new mine next quarter. Reality is slower. A lot of silver ends up dispersed in tiny amounts inside electronics, solder, switches, and medical gear. Recovering it is costly, energy-intensive, and time-consuming. Recycling responds to high prices with a lag, and in a fast bull run, the lag becomes the squeeze. On the mining side, even primary silver projects move on a multi-year clock. Exploration, permits, financing, construction, then ramp up. Price can change sentiment instantly. It can't change geology instantly. 4. Why export controls change psychology. Controls don't need to be a blanket ban to reprice the market. They inject uncertainty. Industrial buyers don't gamble on uncertainty. They build buffers, overorder, and pay up to secure delivery windows. That behavior can tighten an already sticky market even further. Don't sell yet in a market that can flash crash. Here's the honest part. Silver can rip your face off both ways. A bull market can include 8-12% down days, margin shocks, and sudden liquidity vacuums around key session handoffs. That's not automatically the top. It's often the mechanism that transfers metal from weak hands to strong hands. So don't sell yet doesn't mean ignore risk. It means don't confuse volatility with reversal. What matters when we tag 97? If we hit 97, the number is less important than the behavior. Break and hold versus break and fail. Volume expanding versus drying up. Follow through after the first pullback. Gold to silver ratio still compressing versus snapping back. The two-pocket mindset. Same metal, two games. Traders manage risk, size small, and respect stops. Strategic holders watch supply chains and policy and avoid panic decisions off one red candle. A simple exit framework. Instead of one emotional top, use zones. Scale out in pieces on strength, keep a defined core only if your thesis is structural, and set clear invalidations. Key supports breaking, ratio reversing hard, policy shifting, or physical tightness easing. Why this cycle feels different from past spikes. Past spikes were often dominated by speculation and then collapsed when the story cooled. This cycle has a harder backbone, governments labeling silver critical, industries consuming it at scale, and a clean energy build-out that keeps pulling ounces out of circulation. In solar alone, forecasts for 2026 additions cluster around the mid-600 GW range, implying roughly 120-125 million ounces of annual demand just for panels. Add the AI data center electrical build-out, quiet, constant, and global, and you get demand that doesn't wait for better prices. It simply needs metal. If you want, comment your planned exit zones, price and ratio, and I'll build a clean checklist for the next episode. No hype, just rules. And remember, this is market commentary, not personal financial advice. Stay safe, size smart, and don't chase candles now. The China wall, export control changes the market structure. Now layer in the biggest geopolitical shift for this metal. Starting January 1st, 2026, China tightened export controls on silver using an approval-based exporter list. Only selected companies can export under the framework. Let's translate that into plain language. A major refinery and processing center just told the world, "You'll get supply if and when we approve it." That is not a normal commodity regime. That's a strategic material regime, and markets reprice when supply becomes conditional. Super demand, solar, plus AI, plus non-negotiable industries. Now let's talk about where the ounces go. Solar isn't a hobby anymore. It's national policy. Forecasts for global solar PV additions in 2026 sit in the mid-600 gigawatt range, and the solar sector alone is expected to chew through roughly 125 million ounces of silver. And then comes the demand nobody modeled in the old cycle: AI infrastructure. Every data center build-out is a giant electrical conductivity problem. Silver is used where conductivity, heat, and reliability matter: connectors, contacts, specialized electronics. This is hidden demand because it doesn't show up as one big headline purchase. It shows up as thousands of factories quietly needing the same scarce input at the same time. The government signal critical mineral status. And here's where the story stops being just markets and becomes policy. In late 2025, the U.S. added silver to its official list of critical minerals. That's a fancy way of saying, we consider supply disruption a national risk. Once a material is labeled critical, two things become more likely: incentives for domestic projects and stockpiling behavior, direct or indirect. Stockpiling is not investor demand. Stockpiling is a buyer who does not care about your chart. They care about not shutting down production lines. The technical stress signal people ignore: backwardation. There's another signal that gets overlooked because it sounds academic: backwardation. That's when the spot price trades above futures, meaning silver delivered now is valued more than silver promised later. In normal times, futures often price in storage and financing. Backwardation says, forget that, I need it today. When you see persistent backwardation in a metal that's supposed to be plentiful, it's the market whispering, physical is tighter than the paper claims imply. The ratio story: why $95 can still be cheap. Next, the gold to silver ratio. In the last few weeks, it has compressed toward the 50.1 area. Historically, true silver manias can push that ratio far lower, 30.1, even 15.1 in extreme moments. Now do the thought experiment. If gold stays elevated and the ratio compresses further, silver doesn't need a new miracle. It just needs the relationship to normalize under stress. That's why people calling $95 expensive may be anchoring to the wrong decade. 9. So what does "don't sell yet" really mean? It doesn't mean never sell. It means don't sell because a number scared you. If you're holding physical, ask better questions. Has the supply story improved or worsened? Did China loosen controls or tighten them? Is industrial demand slowing or accelerating? Is the futures curve calming down or screaming urgency? Is the ratio still compressing or snapping back? If your answers point toward tighter supply and stronger demand, then selling purely because you saw an all-time high is not a thesis. It's a reflex. The smarter exit framework: scale, don't panic. Here's a framework used by professionals. Instead of one emotional top, you use zones. You scale out in pieces on strength, and you keep a core position in case the market goes full mania. You also define invalidations. For example, if key supports break, if the ratio reverses hard, if policy shifts, if backwardation disappears and inventories rebuild, those are signals, not vibes. And most importantly, you decide your plan before the candle turns red, the warning and the punchline. So yes, $97 is a gatekeeper. But the bigger story is this: in 2026, silver is being treated less like a trade and more like a resource. And when the world fights over resources, the market doesn't ask if you're tired. It asks one question: can you get the metal?